This is part 2 of the introduction of stablecoins to the global economy presents several potential benefits, primarily centered around improving the efficiency, speed, and inclusivity of financial transactions. Here are the key economic advantages. 1. Revolutionizing payments in terms of speed and cost efficiency. Faster and instantaneous transactions. Stablecoins operate on blockchain networks 24/7, enabling near instantaneous settlement for payments. This is a significant improvement over traditional banking systems, which can take multiple business days for cross-border transfers and are restricted by business hours. Lower transaction costs. By cutting out multiple intermediaries, like correspondent banks and clearinghouses, in legacy payment networks, stablecoins significantly reduce transfer fees. This is particularly impactful for cross-border payments and remittances. They offer a cheaper and faster alternative for sending money internationally, which can have a substantial positive economic impact on recipient countries, especially where remittances are a vital source of income. Merchant transactions. Stablecoin-based digital payments can reduce processing time and minimize fees for consumers and merchants. Promoting financial inclusion. Access for the underbanked. Stablecoins can expand access to financial services for people underserved or excluded by the traditional banking system. Since a wallet-based infrastructure is often used instead of an account-based one, they can overcome hurdles like the need for extensive Know Your Customer (KYC) documentation or a state-issued ID. Financial lifeline in high-inflation economies. Dollar-pegged stablecoins can act as a more stable store of value in economies experiencing high inflation or economic instability, offering citizens a way to preserve their purchasing power. 1. Enhancing market and treasury operations efficiency and capital market settlement. Stablecoins can serve as tokenized cash for secure blockchain-based settlement in financial markets, streamlining the process of trading and capital market activities. Optimizing treasury management. Firms can use stablecoins as on-chain cash reserves to improve liquidity, enhance operational flexibility, and reduce friction in treasury operations. Facilitating global trade. Stablecoins, particularly when used with smart contracts, can improve the speed and efficiency of managing paperwork and processes in global trade and trade finance, potentially lowering costs and increasing access for small businesses. Enables bonds to be more diversified than just use in banks for their purchase during auctions. 1. Innovation and competition. Driving financial innovation. Stablecoins are an important part of the broader innovation in financial technology. They can enable new business models and services within the digital asset ecosystem. Competition and interoperability. They create competition for existing payment providers, pushing the entire industry toward greater efficiency. They can also serve as complementary digital instruments, allowing for private sector experimentation and interoperability with future central bank digital currencies, CBDCs. They will offer a counterbalance to the central bank digital currencies, which are also coming in, especially in Europe and Asia. Programmability. Their digital nature allows for programmability, meaning transactions can be automatically executed when specific conditions are met, via smart contracts, which can streamline processes like vendor payments. 1. Supporting financial markets. Stability in the crypto ecosystem. By maintaining a stable value pegged to a fiat currency, like the US dollar, stablecoins bridge the gap between volatile cryptocurrencies and traditional finance, offering a reliable medium of exchange within the crypto universe. Demand for safe assets, treasuries. The reserves held by fiat-backed stablecoin issuers often consist of high-quality, short-term government securities, such as US Treasury bills. The growth of the stablecoin market can therefore create incremental demand for these assets, which can provide the government with flexibility in its issuance strategy. And so this completes part 2 of the look at the pros and cons for the use of stablecoins in this new and upcoming digital economy.